Welcome to another episode of Inside Startup Investing. As always, I am your host, Chris Lustrino, founder and CEO of King's Crowd. Inside Startup Investing is the #1 podcast for learning about the best startups and investors in the online private markets. If you are a startup investor, this is a show for you. This podcast is powered by King's Crowd's proprietary rating technology that helps us to uncover the best founders and stories that you need to hear about before clicking invest. Now, before we get started, we want to thank our sponsor, LawCloud, the premier solution for founders to prepare to raise capital online. Whether you need to file a Form C, a Form 1A, or a subscription agreement, LawCloud provides the lowest cost, easiest to use toolkit for founders to make raising capital online easier than ever. Now, on to today's show. Today, we are joined by John Panaccione, who is the founder and CEO of Folla Capital. Folla Capital is a new marketplace on the scene in the equity crowdfunding industry, and I think they have kind of a unique lens and angle that they're going after, which I'm really excited to explore more. I have followed John's story for quite a while. He's been a contributor to Forbes for many years. He's written some really interesting articles on the space, and it's been someone I've wanted to speak to for a good long time. So excited to have this conversation here today, and hopefully you are as well. So with that, John, thank you so much for joining us here.
Hey, Chris, thank you for inviting me. I feel privileged to be here. Thank you.
Absolutely. So let's kick it off, learn a little bit more about you, and what are you up to at Folla Capital?
Well, I want to 3 founding partners here. So I have my role, which is typically talking to people about capital raising in general. And then that's kind of my area of expertise. And then, you know, I couldn't be happier with how things are going with the market and how things are, the innovations that are occurring, which I'm sure we'll get into. And I just love my job. And so that's what's going on at Folla. So far, so good, and can't complain. Can always be better, of course, but things are going well. You know, we're in about our 3rd year if you look back in time. But I'll be brief. I did some time in the Army after college, jumped out of airplanes and stuff, and learned a lot from that. And did corporate America for a while. Then I founded my first company in 2003, a startup. So I've actually been on the side of having to raise capital. So I raised a couple $1 million in equity from investors. And even though I had an MBA at the time, you can't teach this stuff. So, I was an operator for a while. I actually ran that company for 17 years and sold it in 2020. And before I sold it, we actually were getting into North Carolina's intrastate crowdfunding program. This was years ago, as a software provider. And my old company was the first and only, at the time, software provider authorized by the Secretary of State's office in North Carolina to be the provider for the platform. That's how I got into this business. Originally. And along the way, I started a nonprofit for veterans looking to get into business after they leave the military, and Folla Capital is my 3rd company.
Very cool. Well, first off, thank you for your service. Thanks for jumping out of planes. And let's talk about that evolution where, you know, you were playing with those interstate rules, which for the real geeks who are very into this was kind of like a first round of creating an equity crowdfunding type environment. And now where we are today, what inspired you to say, you know what, let's take this a step further and get into this kind of newly emerging space?
Long story short, my company always needed about $1 million in working capital. And as many listeners might know, that's like no man's land. Or, you know, it's too high for angels, too low for VCs. And I find a lot of companies are in that zone. But, you know, Reg CF now, for example, as we all know, can give up to $5 million, which is one of the reasons for that. But at the time, my company, for years, we were profitable, but working capital, we always are undercapitalized. And that number, 1 million, is what I needed. So I was searching for all different ways to get $1 million. I was looking at EB-5 programs. I was looking at all kinds of stuff. And then along comes Reg CF and the Jobs Act. And then I was studying that, and of course it took years for the SEC to put the rules in. We all know that story. But during that time, the different states were adopting intrastate rules, and I was tracking it in North Carolina, which is where I'm at, where my business was at. And lo and behold, as soon as it got approved, I literally had a meeting at the Secretary of State's office, a face-to-face meeting, old school face-to-face meeting, and they were the staff there was happy that a company wanted to raise money under this new law. And they said, well, that's great that you're here. The good news is you can do it now. I said, I know, that's why I'm here. I said, is there bad news? He goes, well, the law says you have to use a state-approved crowdfunding platform. And I said, okay, which one is it? They said, we don't have one. So during my 2-hour drive back from Raleigh, I was mad. And I said, wait a minute, I own a software company. So I got with my head engineer, my CTO, and I showed them the requirements, and they go, we can do that with our product. So we began to modify our product, working with the state to meet its requirements. And lo and behold, a few months later, we were authorized to facilitate raises in North Carolina. So that's how I got into it.
Got it. And you made a great point, which I want people to like really understand, which is, if you go out and try and raise about I'd say even $1 to $3 million, it is amazing. I mean, most VCs will basically just pass because they'll say it's not big enough. If you've watched kind of the size of funds over the last 20 years, they've increasingly gotten larger and larger and larger. And because of that, they need to take bigger and bigger and bigger bets. So if you're in that range of needing 1 to 3 million, they can't make a big enough bet to make it exciting for their portfolio. And if you're above like 250 to 500, every angel is going to basically tell you, there's no way I could fund enough to get you there. So I really don't want any part of this because I don't want to take on the risk of being the only one funding this thing. And so it does. It creates a very precarious situation, which I can tell you I've been through very much myself. I was laughed out of like 30 plus rooms when I was trying to do $1 million round by VC saying, good luck, and we want no part of this. So I know exactly what that's about. And I think there's a huge value in helping those types of companies. Now, obviously, there's many platforms out there. There's a handful that are the biggest, and then there's kind of this long tail. Where do you position Folla Capital? What is its unique differentiating factor, and what do you hope kind of makes it stand out from the pack?
Great question. So, well aware of who the players are in the industry. So we're a SEC registered broker dealer, first of all. So we're in that group. And we spent a lot of time and money getting there, and very hard to become one of those, as you know. And one of the reasons I feel personally, and my partners feel that that's important, is we want to be able to give advice. So, and we're able to. So our approach is to actually work with small business owners, startup entrepreneurs, or people that have an active business. We're about 50-50 with our portfolio. And to be able to assess what they're trying to accomplish and what they already have and what they've done, and say, all right, based on everything you've told us, Reg CF's not right for you. You should do a 506B or a Reg D 506C, or you should do a side-by-side, or you should get a bank loan, and we think we can get you one. So that's kind of the approach we take. We're not a one-trick pony with Reg CF, and I think that's what makes us different. Second, we're not exclusive to, but we focus on veterans in particular, military veterans, but we also have a passion for women and minority-owned businesses. Those three groups have an extra hard time getting funding from traditional sources. So we love to help those folks because between me and the partners, we've kind of experienced that personally and understand that. So I think those two things, we're a broker-dealer, and we try to give advice on which approach to take, which exemption to use, number one. Number two, we work with those specialized groups as a primary focus. And I would say there's a number three, too. We don't pass judgment on anybody. We don't say, no, we think your business sucks and we don't want to work with you because we think you're a loser. We don't say that. We allow people to come in and say, here is the process. Here are the regulations. We're a broker-dealer. We can help you with this. We have a duty to the SEC and FINRA to do some level of due diligence and make sure that you are filling all the blanks and checking all the blocks. So we are going to do that. But if you're willing to, we'll take you on. We're not going to pass judgment. We like to let the community decide who's got a good business and who doesn't. So we don't like gatekeepers. Those are the three things I think that differentiate us.
I think that's terrific and very much in the spirit of, I think, the law, right, of the Jobs Act, trying to create a marketplace where let the people decide what they want to invest in, what they don't want to invest in.
Right.
I think that makes a ton of sense. So talk to me about some of the early successes and early challenges that you've experienced in creating this new marketplace?
So, there's been lots of false starts. I mean, with any business, you don't bat 1,000, right? So we all learn from our mistakes. Even capital raises aren't guaranteed. So as a business, we've learned that too. We've absolutely continuously improved our own processes and stuff. Our first issuer was a group called Harmony Global Foods up in New Jersey, minority-owned business. We were successful 1-for-1. And very happy about that. We raised about $180,000 for them, and it was a meal kit company during COVID. And we're very happy about that. We've had a couple of people that haven't hit their goals, and we've had a couple of people that have hit their goals. So we're averaging about what the industry average is for successes. So we're quite pleased with that. We've really rethought the process a lot, and I can get into that. So when we first started, we were I started focus from intrastate in North Carolina to then a focus on Reg CF. And now we're focusing broader. These exemptions that have existed for years can be used by many companies. In fact, oftentimes they're a better fit than Reg CF. So I think that's what we've learned, that Reg CF isn't a silver bullet. It's not a one-size-fits-all. There's really, people need to use that exemption when it makes sense, and there are better options sometimes, and I think that's what we've learned.
Absolutely. Yeah. And I always kind of say, capital is a commodity, and you need to, and the capital stack has become deeper over the years. So yeah, you have your 506B for your most traditional raise, you have your 506C, you have your Reg CF, you have your Reg A+, you have all these options at your fingertips, but picking the right one at the right time is really, really important. Probably one of the greatest challenges that our industry has found is driving investment, getting investors to engage. And it's funny, I probably heard from, I've talked to hundreds of founders since we started this company. I'll say, well, what's your capital raising strategy? Well, we have 3 million followers on Twitter. And it turns out like you might get a 1% conversion on that on a good day, right? So it's not easy. What are you finding as effective ways to create investor engagement?
That is a great question. I'm a geek when it comes to this topic. I've taken 5 SEC exams on my road to becoming a broker-dealer, and I've had to study this issue. And I read books about the Great Crash in 1929. And I say all that to answer your question. In America, it's a big change management process, for lack of a better word. We have 2 generations of people. In May of this year, it's the 90th anniversary of the Securities Act of 1933. So for 2 generations of Americans, most families, 89% of U.S. households are non-accredited. For 2 generations in those families, no one's been talking about investing in private businesses. And we joke, you've probably heard this before, Chris, but, in 1933, the government, for all the right reasons, said, you can't invest in a private company unless you're accredited, for all intents and purposes, right? But they didn't say we couldn't do other things in life. Like the government never said you can't invest in rental property or real estate, right? You can do that and be a non-accredited. No, the government didn't say you can't go to Vegas and gamble your life savings away. The government never said you can't start a business and put 100% of your savings into your own business and lose it all. That's okay. But to write a $5K check for your buddy's company is illegal, right? So we've had 2 generations where that hasn't been part of our American home conversations. The accredited families, though, never stopped, right? So those families keep talking about that from generation to generation, but most Americans haven't been able to. So I think that's the biggest challenge at the macro level. And I think the younger generation is really adopting this because they don't have a history, right? So because they can now, and it is legal, and it's something that we all can do with our money now, more people are doing it, but it's not happening overnight. And that's the biggest struggle, I think. It has a lot to do with 2 generations of not being able to do it.
You know what? I haven't heard it said better than that, which is, I always say it's an awareness issue, but it's an awareness issue deep-seated in 2 generations, 70, 90 years now of people basically being unaware or knowing that
unable to,
not even thinking about it. And now suddenly it becomes accessible to the mass market. It's a great point. So going off of that, what are some of the ways that Folla Capital is thinking about how we overcome that hurdle? I mean, it's a long game, right? Like how do we get there?
Well, again, it is a long battle. It's not going to happen overnight. You know, we kind of look at things at the end of the day. I think the theory that you hang your shingle up on a website and sit back and watch the money come flying in from total strangers is not reality. And I tell people who come look at us as a potential company that might want to help, I said, if you hear that from a platform, run like hell. And I firmly believe that. Because if you look at the stats, right, some of which you report, that's not the case. So it comes down to the good old school. You need to go out and develop relationships, sell your story, and get people convinced to write a check. Platform or no platform, that has to happen. And, you know, we have this thing we do called the top 5 things you need to know to be successful with this. And number 1 is you got to be able to sell. You got to be able to do 2 things that are hard at the same time. 1, explain your company in a few minutes so it makes sense, it gets people excited. And 2, ask people for money. Both those things are hard. And when you're raising capital, you're doing that at the same time. And if you never sold anything in your life, good luck, right? So I don't know if I'm straying from your original question, but it's you know, that's what we're seeing. It's hard. It's always going to be hard. And when you go to a pool of people that have never invested in a private business before, it's even harder because they have no idea how that works and they're afraid of it because it involves their money. So that's what I think the main challenge is. So to answer your question, it comes down to people that trust you or believe in what you believe in or feel like they're part of your tribe. Those are the ones we're seeing write checks. So when it comes to veterans, minorities, and women-owned businesses, for example, people that attach themselves to those groups have a trust level that gets you at least halfway there to writing the check, right? Yep. And now the rest of it, you got to convince them. But at least you get a good head start when that's who your primary target investors are, people like you.
If we look at, you know, the biggest players that are out there, your WeFunders and Republics, you know, they're relatively well-funded and they're definitely spending money to both source deals and to source investors for founders. Folla Capital, from what I can gather, is definitely a smaller shop and potentially even bootstrapped and funded by yourself and maybe your partners. So how do you think about growth? How do you think about success when you're going up against kind of deep-pocketed platforms?
You know, I've had almost 20-year career in the software industry battling Goliaths, and I was, you know, running a little software shop. We had great customers like Fortune 100 companies, but we were the little itty-bitty software company. So I'm used to it. I think you take good sniper shots to hit what you aim at versus, you know, trying to mow everybody down with a machine gun and try to get market share, because I think you become good at what you do because you have to. And that's been our strategy, right? We can't afford to make a lot of mistakes or throw a lot of money at wishful thinking. Like, we have to be very precise, starting with the SEC regulations. We have to make sure we're following those rules to a T, number 1. Number 2, we got to give good advice to our clients. I must say, and I'm not one to criticize or be negative, but I don't think it's good for the industry, so I'm going to speak up. I think there's a lot of stuff out there on some platforms that are shockingly lack of due diligence. I'll just leave it at that. You know, particularly with Reg CF, other than an audit perhaps or a review, there's not a lot of requirements for specific due diligence. One of the advantages of going through a broker-dealer is the broker-dealer is duty-bound to the SEC to conduct a level of due diligence before they offer the security. That's one big difference between broker-dealer offered deals and platform offered deals. And when you go to deals that have not gone through some level of due diligence that's a little robust, I'm not sure what's being offered to the public are good offers, and then that could give us you know, some dark stains on the industry over time if that's not cleaned up a little.
Well, I think it's an interesting point you make, but I want to ask you a couple of questions here. So I've gone through CF, I've gone through A+, I've gone through 506C, kind of done it all, partly with this idea of really understanding the industry, eating your own dog food, and making sure we're going to be the data provider. We also need to know what it's like to truly go through this experience. I will tell you, CF, yeah, it's easy. I mean, it makes it accessible to nearly any founder. A plus is deeply difficult, painful, and oftentimes cumbersome in a way that I don't think the rules intended, but is how things are structured with the SEC and what have you. And that's just the way it is. So what's the happy medium between your CF and your A plus, where A plus is maybe too intensive for startups, CF is maybe slightly too easy from what you're talking about? Where's that middle ground?
Well, I think it's an easy answer. It's Reg D, right? So you got three flavors of Reg D. You got 504, 506B, and 506C, right? 504 has some state requirements. Typically, lawyers use 504, right? So because they're part of the state bar. So when they did capital raises the old-fashioned way, that might be the exemption that works best for a lawyer-led traditional round, the old-fashioned way, like I did back in the day. But with public offerings, whether they're on a platform through a broker-dealer, because it's not a Reg CF or not, 506Bs and Cs, we're big fans of 506Bs and Cs. And my argument for the requirements, yeah, they're robust, but having run a business and raised capital and now helping companies package up their offerings, those requirements just reflect the level of due diligence that I believe all companies should go through, including our Reg CF deals. If you look at our Reg CF deals on our platform and look at the information we're disclosing and the projections, and it's the same due diligence a Reg D offering goes through with us, right? And, I think to answer your question, Reg D would be my answer. Reg A's are very cumbersome in terms of the requirements. Reg CF are more relaxed. And Reg D, I think, is a good happy medium.
I'm actually curious to hear that because, I again, just in my own experience, in Reg D offerings, like technically I'm not required to provide any information. It's kind of what the investor asks. Sometimes they ask really technical, deep questions. Sometimes they don't ask anything, and they just say, "Sounds good. Send over the paperwork." So to me, like in some ways, there's less disclosure, and you don't need to have an audit. You don't need a review. You could just kind of give them what you think. Partly I think that's why like an FTX can happen because they didn't need to have anything audited. So I'm like not shooting it down, just trying to understand like what you think about Reg D is enabling better due diligence versus CF.
Well, yeah, that's a great question. And I think a lot of it has to do with Reg Ds allow you to go to more traditional investors, right? In some cases, you're limited to like a 506B, for example, it has to be people you know, right? So my answer to that question is when you go to raise money the old-fashioned way to traditional investors, you got to give them a lot of information. I mean, when I had my software company and I was working with VCs to potentially it's months of due diligence and projections and all this stuff they want to see before they write a check. So it doesn't matter what the SEC regulations say you have to have. It's whatever a more sophisticated investor is going to expect to have before they write a check, right? To me, it's more of the latter. So you might use a Reg D 506 or a 6B or C, and it doesn't really matter what the regulations say on one hand. It's the robustness of the due diligence and the material presented and how it's presented that's going to gain the confidence of a more sophisticated investor to write a bigger check. I think that's kind of the answer there. I just read an article you're probably aware of about Shark Tank, right? And how on the show everybody says, I'm going to put 50 grand in there, and then like 70% of the time they never get any money. Yeah. Well, that's because they should due diligence and they don't see what they need to see to write their check. I think that's what it's all about. No matter what exemption you use, even Reg CF, this a certain level of due diligence and material, I think, needs to happen to be successful if you're an entrepreneur raising money at all, right?
No, understood. And I absolutely agree with that point. It should be a rigorous process, and you did need to, fight the good fight. So that makes total sense to me. So with that kind of mindset for Folla Capital and, being more of a sniper than machine gun, perfectly well said for a guy from the military. What is your measure of success for Folla Capital over, call it the next, 3 to 5 years? I know 5's hard. Maybe we talk about it.
Yeah, we have a couple of measurable goals. We want to raise 10 million this year, which is a lot for us. And, we're pacing towards that. We're getting much better in terms of our scalability being a software person, that's what I focus on, scalability. So that's a selfish, measurable goal. But, our real measurable goal that means more is the success rate of our clients, right? We're never going to bat 1,000, but I'd like to do above the industry average. If 60 to 70% of our clients are hitting their goals with their raises, we're really happy. Whether that's a $10 million raw selfish goal hit or not, it's the batting average of our clients achieving what they want to achieve. So that's what we're hoping for. Above average success rates, and selfishly at least 10 million in capital raised this year.
I like that. A quality over quantity, and saying, hey, we could do just a few deals, but if those deals do exceptionally well, that is success. Versus we did 1,000 deals and they all raised 100,000. So we hit our goal anyway, but did anyone really succeed?
That's right. Yeah, a little bit of both, quality and quantity, right? And the balance there is important.
One other question for you here, just because I think you sit at an interesting point to be able to think about this. You have the type of company that can be venture-backed or will be venture-backed or already is venture-backed, more of your typical startup, high-scale, high-growth type of company. And then there's this other type of company, and it kind of hits on your point about like these companies where maybe you need $1 to $3 million, you don't really fit any bucket, could be the perfect type of company for a private equity buyout or just a buyout. And if it's priced right, $2 to $5, $10 million valuation, and you could grow into a $45, $50, $100 million valuation, a minimal capital raise, that could end up being a really terrific outcome for any investor, even a little bit smaller than that. So with that in mind, how do you think about some of the companies that raise on your platform? Like, there's this intersection of this could be really good for a venture-backed type of company, but also more of like this mid-market private equity type of company. What are your thoughts on that? I'd love to hear that.
Well, good question. I think every company's profile is different. Their exit strategy is different. And whatever's unique to that company that makes them different defines what their funding strategy should be, right? So if your exit strategy is to grow, like you said, from to $40 million in revenue from say 5, and you want to exit in 5 to 7 years, that's an equity investor. And you might want to do a not a Reg CF, but a 506C, or and go after traditional investors that can write big checks that Reg CF investors can't, to get you the capital you need, that is going to be patient to wait. On the other hand, if you're opening up a bar, right, a beer joint, equity is probably not even a good idea, period. So maybe it's a debt deal. We do a lot of debt deals, by the way. We can get into that. Maybe it's a revenue share agreement with nice perks for that beer place, and that's a better solution for them. And it's two very different groups of investors. So I think that's very important for people who want to raise capital to think through. What's your exit strategy? How much capital do you need, and who's your target investor? And then kind of back up from there to engineer what kind of offering you should offer and which exemption to use. Does that make sense?
It makes a ton of sense. No, I think that's really well said. Well, John, thank you so much for your time today. For folks who are interested in going to Folla Capital, becoming an investor on the platform, looking at some of your investment opportunities, where should they go? What should they do?
Yeah, follacapital.com is our website. We also have a YouTube site where we got a whole bunch of educational material, including like a little 18-minute TED Talk kind of thing that talks about the Securities Act of 1933 and some history there, because without understanding that context, it's tough to understand what Reg CF is doing and why it's here. So I encourage anybody to go to either the YouTube site or our website.
Love that. Well, John, thank you so much for your time. Thank you so much for your insights. And to all of our listeners, we appreciate you joining, as always, and have a wonderful day. Thanks so much for listening. As I mentioned, Inside Startup Investing is powered by KingsCrowd. If you want to use the same tools I do to power your investment decisions, you can head on over to kingscrowd.com/startups to try out our Edge Pro Toolkit for 30 days free.